For those of you that have followed Winner's Edge Trading, you know that they're kind of a no-nonsense type company as well. They'll do a great job educating you, and so I know that we're looking forward to the next hour and 15 minutes with these guys. So I'll turn it over to you.
Hey, Morgan, thanks so much. And hello, everyone, and thank you guys for being here. Thank you so much, TradingPub, for having us. It's an awesome event, as usual. Anytime you can get 900 people to show up for an event, you know that you're doing something right, and so we're certainly happy to be a part of it. I just wanted to give Chris a little bit of an intro. Chris is going to be our main speaker for the Winner's Edge session here, and he's our trading room host. And so today what he's going to talk about is the difference between just what a trade setup is and when it's actually time to pull the trigger and make a trade. And so what I wanted to ask was how many people in here would consider themselves chart traders? In other words, people who use technical analysis to determine when they're going to make a trade looking at the charts. I'm assuming that's a high majority of you who are manual traders using charts to determine entries. Yeah, that's kind of what I thought. And so, really what's the major difference between profitable manual traders and unprofitable manual traders is that some manual traders ignore good setups and some manual traders ignore bad setups. And of course, that's oversimplifying it. But at the end of the day, every strategy, whether it's a trend line break, a reversal strategy, or a moving average crossover, or using pin bars, whatever the strategy is, there's going to be a million different setups. And if you take all of them, you're going to lose, no matter what the strategy is. Any basic strategy, if you take every setup, you're going to be a losing trader. So what turns you from being a losing trader into a profitable trader is when you eliminate some setups, you confirm some setups, you change some setups, and you use the discretionary portion of trading, which is a really difficult part because it's not, rules based where you can just, follow X, Y, and Z and become profitable. And so what Chris is going to try to cover today in just, a quick 45 minutes is this idea of going through the discretionary process to determine when you should take a trade setup and when you should ignore a trade setup, because all trade setups are not the same. All trade setups do not mean that you pull the trigger. And so we're going to talk about a few things today. Chris is going to go through kind of that process. And I think if you're someone who's using a manual strategy, if you consider yourself a chart trader, understanding this process and how to ignore some trade setups and take some trade setups is going to be really critical to your success. And so I'm going to pass it over to Chris. And again, I thank you guys so much for being here. If you want kind of a basic strategy to follow along as Chris is talking about, you can download our little free report. I think Morgan actually has a link to that. You can download that ahead of time so you have something to kind of follow along with Chris on. But that will kind of give you a basis for what he's talking about. But this really goes with any manual strategy that you'd be trading. All right, Chris is getting his mic set up, guys. Just hold on one second. And Morgan just posted that link. Thanks, Morgan. Normally, I know we do that at the end, but it's kind of going to give you a little bit of a template. We trade currencies, by the way, but that doesn't mean that that you have to trade currencies in order to use these kind of technical analysis principles. This works for anyone who uses technical analysis as their way of trading. I'm going to do at the end, but I'll talk about now. As Morgan mentioned, we're Winner's Edge Trading. And basically, we focus on currency trading from a technical analysis standpoint. And so that double trend trap report that Morgan tossed out there is our favorite way to approach the intraday markets. It's using very basic principles, which is how we like to operate without flooding people with indicators and too many rules and things like that. It's a very straightforward approach to the markets. And what it uses is trends on the intraday and daily time frames. And then it uses price action and trend lines in order to determine how to actually enter and manage those trades. So instead of coming from a standpoint where you have indicators that say to do this, this, and that, and then enter the trade with a 50 pip target and 100 pip stop or whatever those rules might be, we use the market to determine those things. And it's a really critical component to going from just a strategy to an actual profitable trading system where you're using the market to your advantage. And so that double trend trap report is a very basic form of that strategy. Of course, one report isn't going to give you all the keys to the kingdom, unfortunately, but it's a very basic look at what we're doing in the market. And then when you build on that and you use the other components, like the things that Chris is going to talk about today, it takes you from being someone who's trying to follow rules and trying to understand a strategy to someone who's using the market clues in order to increase their accuracy, increase their profitability, and do the things that separate, that small percentage of traders who are actually making it in the market. And one of the things that we like to talk about at Winner's Edge Trading is the idea of eliminating bad trades. Because let's say you're someone who takes 100 trades in a year, and you're averaging a 1-to-1 risk-to-reward ratio, and you win 50 and you lose 50. Well, that's obviously your break-even point, and typically you throw in spreads and commissions, and you're losing at that point. And when you can take that same principle of 1-to-1 risk-to-reward ratio, winning 50 trades and losing 50 trades, and manipulate that with small things like, okay, I'm instead of taking every trade that when there's a a trend line break, I'm going to wait for a Fibonacci confirmation of that reversal point. So when a trend line is being broken, obviously one thing, it was going in one way and it turned and went in the opposite way to break through that trend line. Well, that might win if you set a 50 pip stop and 50 pip target, just to use arbitrary numbers. That might win 50% of the time and leave you at that break even and actually losing. And then if you throw a component onto that, like confirming it with the Fibonacci point, that's
Nathan.
enough typically. Oh, hey, Chris, you're there.
Yeah, sorry about that, folks. There was a permission button at the end that I didn't see when selecting the microphone, and that was the reason why you didn't hear me. So learn something new about technology. Sorry about that. I will continue now finally. I wanted to thank, first of all, Morgan and Nathan, and all of you actually for your patience when I was fiddling around with this microphone. So once again, apologies for that. Nathan, is totally true that we wanted to take a look at the discretionary part and how you can make discretionary trading a bit more profitable. So we're going to take a look at the elements that we use in our own trading room, in our own strategies. And now, of course, you can use these elements as well for whatever strategy you use, or maybe you'll decide to use our strategy one day and use these elements to help our strategy. Whatever the reason, let's take a look at what kind of things you can do to optimize setups, distinguish bad and good setups to enhance the trading performance. So I hope the audio is still good and good to go. Maybe a few yeses would be nice. Just okay, good. I got a confirmation from Morgan. Got a bit scared there, so just wanted to make sure. So here we got a slideshow. We were taking a look at this a while. That basically basic trade setup, right? We're looking at a bull flag, break, or zoomed in version of that. So let's move on to the next one. We're going to take a look at the discretionary trading, as I was saying, and it's part of the manual trading, of course. And we're going to take a look at what can determine or help determine whether a strategy or trading plan can increase or optimize that profitability. Now, the three things that we wanted to check or introduce to you is this following three: the multiple time frame analysis, the risk to reward, and the price action. And what we're going to do is actually give you some real life examples. So instead of giving you a bunch of examples one after another, we're going to dive into practical examples of trade setups that we've taken in the trading room and show you the step-by-step process that we do through that trade setup. So we're in this trading room, and then we do a certain process step by step, and we're going to take you through that process. And I think that process itself has more value into what elements we think of and look through than just giving you loose examples one after another. So let's start with the first one. In fact, here is an example of a trade on the euro dollar, the 1 hour chart. And we entered in the orange zone and we exited at the green zones. So what made us make that decision here? Of course, you only see part of the price action, but what made us? So we're going to discuss that right now. First of all, what we're going to emphasize in this example number 1 is the multiple time frame analysis. So that would be our core focus of this example. So once again, how did we confirm this entry? What work was done? What kind of analysis was made here to come up with that winning trade? So let's take a look. First of all, this is the daily chart. Again, of course, the euro dollar. So what things do we see here? I'll give you a few seconds to put your eyes at rest and take a look at this example. First of all, maybe take a look at the bottom where we have the oscillator and there's a line connecting the tops. Now, of course, clearly we have now divergence on a daily chart like that, of course, potentially eventually could lead to a reversal or retracement at least of that uptrend that we do see on the chart. If we look then to the price section of the chart, what do we see here? We see green lines indicating the uptrend and of course price nicely respecting that uptrend channel. We also see maybe a bit of a rising wedge. If you look at the black trend line and add maybe a trend line here as well to it, it could be a potential rising wedge pattern. Moreover, let me put that back on full scale 1 second. There we are. If I use my drawing tool, unfortunately, the full scale mode is lost. That's why. But in any case, you can see also a Fibonacci retracement key. We hit the 50 fib, and if we move forward and higher, you see a minus 618 at the very, very top. That is the target, the reason why maybe the price could move down from there. It did indeed exactly at 137 level. So just to give you an idea, on the daily, we see potential reversal patterns and setups or signals, let me say it this way. So that's step 1. Right? We want to trade with the trend in our trading room, but we also want to be realistic about what the trend can do and how far it can go. And if we see realistic signals that the trend might be ending, we want to bend with the trend and be flexible about that. So once that happens, this is the 4-hour modus. So we zoom in, and we see there too a divergence, and we see a break of the green uptrend channel, the bottom uptrend channel line, right? With a clear, very impulsive. Surely we can actually start building a downtrend channel indicated by the black channel there, and that potentially the new trend direction. So this is how we try to be flexible with the trend. We want to trade with the trend, but we also want to be flexible in seeing potential new trends set up as we do here with the green and the black channels. Once that is complete, well, we can take a look at the 1-hour chart. And what do we see there? We see a break of a single line trend line, a very impulsive break, in fact, and we see it followed by a correction to the upside. So we see a break of that green line, and we see, we can put a fib, for example, to see what resistance might be the turning spot. In this case, came close to the 78.6, probably some 10 pips shy. That sometimes happens, of course, in the market. So not only that, but we see a resistance line close by. So those are good reasons to consider when in a downtrend, of course, already as a potential turning spot for more downside trend continuation. Also, if you look, the fact that the downside was very impulsive and the upside was very choppy, that is usually a reason to see continuation. Thanks, Face, for that. Didn't realize that it's the oscillator. I said indeed the more of a hard sound there. Thanks for that. If we trade rising trend breaks, no, we see them as actually reversal signs, but we don't trade reversal signals. It's for us more signals to get out of with the trend trade their end. So that's how we would look at that. Okay. The RSI, it's not. It's the AO, which is the awesome oscillator. Okay. And we really focus with 4-hour trends. So because that is our trading plan, we stick to that rule. Now, of course, I'm not saying that everyone needs to do that, but we want to focus on executing our trading plan. Therefore, we would only trade with the 4-hour trends and not look for reversals. So that's the answer to the question of Gailey D. Okay. So that's the multiple time frame analysis. As you see, we were looking at the daily, the 4-hour, and 1-hour to get that overall picture. Now, of course, there's the next thing we always measure is the risk to reward. Jeff mentioned that as well in his analysis of options. Here too in Forex, we also look at the risk to reward. And that, of course, certainly there when you have a pullback like that and you're aiming for the Fibonacci targets, right? If you enter at the retracement and you aim for the target and you put your stop loss above the swing high or swing low, then depending on which fib you take, you always have at least a multiple of 1-to-1. But if you take a deep fib, then you actually have closer to a 2-to-1 or sometimes even 3-to-1 trade, depending on how deep the fib is. So that is, of course. Then let's take a look at price action. What else could we look at to confirm the analysis? We have a downtrend on the 4-hour chart. We have certain price behavior. We have trend lines confirming that. So is there anything else? Price action definitely could tell us a story, right? So let's take a look at that zoomed up on the hourly. This is actually the same chart, but just totally blank. And what do we see in the right corner here? A big pin bar right at that fib level that we, of course, know from the previous charts. And a big pin bar like that, a nice confirmation. Of course, a pin bar like that on the hourly chart wouldn't definitely recommend to sell or buy automatically just as a standalone strategy. But in the context, in the confluence of the other tools and indicators and analysis that is done, this is the extra drop that makes the trade setup interesting. And it is the extra added confluence that makes it very interesting and a great setup, in fact. Whereas if this pin bar were to have occurred in the middle of the playing field or after a large down move, these signals then definitely become less interesting. So if you have pin bars, 1-hour pin bars, as a standalone strategy, you would have many false signals. Of course, the fact that this signal happens after a corrective uprun in a downtrend adds to the juiciness of the entire setup. So the price action definitely a nice confirmation of the analysis done already. So this is the entire scenario, in fact. It's a bit zoomed out, still the 1-hour chart though. And you can see how basically where we have the fib, the impulsive break, the correction back to the 61.8 Fibonacci retracement, and then basically all the minus targets that we use in the trading room. And most of all of these, as you can see, nicely respected. When price went to the targets, they either stopped for a substantial point in the at that spot, price made a big consolidation and spiked up. Then to continue finally, it paused at the minus 618 for just a bit and then made a bigger consolidation at the minus 1,000 target before continuing all the way to the minus 618. Now, this is, of course, sometimes we try to aim for higher targets, I'm going to say it this way, or in this case, of course, lower price. But not always. Our main target is the minus 272 and the minus 618. If we deem that there is enough space, we do try to juicing up the R2R, the reward to risk, by aiming for even higher targets. So like the minus 1,000 or even the minus 168. Okay. In this case, not, but you can see how the targets are nicely respected, though, and that's always important to know that basically the numbers we use are also the numbers that the market sees for whatever reason. So that was the first example where we went through all of the elements, the multiple time frame, the reward to risk, and the price action. Now, of course, we're going to give you two more examples in a way. Of course, this process is different with every setup. With this particular setup, we had variables X, Y, and Z this way, and A, B the other way. Of course, in every reward to risk could be a bit different on this example, and again different on the other example, right? This is, of course, the difference when you're looking at trade setups where you have to factor in all these things, and we think that these three elements will definitely help you with making that analysis. Anne is asking if we take some profit off on the way, and if so, where? Yes, we do at the targets, though. We do a bit of trade management on the way to protect ourselves, but the trading plan is always at the fib targets with this particular strategy though, okay, which is actually a basically a pullback Fibonacci strategy. So example 2, this is actually more focusing on reward to risk, because we're going to show you only one time frame. It's again the euro dollar 1 hour chart. And what do we see here? We see two purple lines. They indicate and box in a consolidation zone, right? It's a chart pattern, it's a triangle, it's a box, it's a sideways zone, whatever you call it. Basically, what it boils down to is that price is bouncing back and forth between two levels, and it can't break out either one of these levels, right? So that's why, of course, when you're using those trend lines, they indicate that particular zone. And when price were to push through one of these two levels, of course, you have a potential breakout. Some breakouts are false, some are sustainable. We want to measure which one has the highest probability of a good breakout. And there are definitely ways to do that. Reward to risk, multiple time frame analysis, and price action are ways to confirm whether that breakout is sustainable. So besides the pullback strategy mentioned in the first example, this is actually an example of a potential breakout strategy that we also use in our trading room. And the reason why we didn't take this particular breakout to the upside was because of support and resistance. Yes, this is example 2 indeed. Yeah, that's on purpose. So no problems. So the reason why we didn't take that is because of a higher resistance. Which resistance? The daily 61.8% Fibonacci retracement fib. When we calculated the distance from the break of the trend line, the higher trend line, up to the resistance, and we looked at what the potential risk was, right? That's the reward. The green box there, the green circle, is the potential reward. If we calculate what the risk was, we figured out that it's not worth the entire risk on the trade, all right? And you can see the trade breakout really just basically hitting that level and then closing and reversing all the way back to the bottom of the triangle. So you can see that for whatever reason, the judgment was correct here because we didn't really get much thrust after the breakout. We were not looking for a small breakout as indicated by the green circle, but more looking for a sustainable long-term move up. And because of the orange resistance, we didn't deem that space there, this wide open space. That's basically what we're looking for, or at least some open space if we can't find wide open spaces. And we didn't see that on the euro dollar and therefore avoided it. And well, that judgment in any case played out. Now, the funny thing is, of course, is that you get a tremendous 0.4. It says a very bullish price action candlestick. Off of that bottom of the triangle, you see a tremendous bullish reversal candle pattern. In fact, that's a very big candle for 1 hour chart. It's a very big bullish candle. To give you an idea, the low of that candle to high is almost 100 pip candle for a 1 hour chart. As you probably know, a 100 pip candle is a big one. So that was funny enough after the kind of like a mini false breakout to the upside. We got a sustainable breakout just a few hours later. To be precise, about 7-8 hours later, you can see the bullish price action candlestick off of the bottom of the triangle, and then a sustainable break through the level, the orange trend line, a small hook back, and continue. So not that we took that one, but this was more out of interest for you to show you how the true breakout looked like in this example. Okay, let's move over to one more example, a very actual example, yesterday to be precise, where we were looking at, together with traders in our trading room, at our double trend trap strategy, as we call it, or DTT in short. One of those two is the boomerang. We were looking at the dollar yen. So we're going to take a look at that example and go through all the slides together to show you all the angles of that. Okay. So once again, at the end, at the beginning, you already saw a link to that DTT. That's a free strategy report that explains the boomerang and the strike trade setups. Okay. So here's that dollar yen chart. So first of all, the daily chart. We were looking at this together with our traders. We were saying, okay, this is a triangle, of course, on the daily and the weekly. It's visible too. Basically seeing a consolidation after a tremendous uptrend. And I wanted to zoom in. You don't see the uptrend here, but there was a tremendous uptrend followed by this triangle and a break of that triangle to the upside. And you can see how price pushed through the magenta triangle formation consolidation zone to form this very bullish uptrend channel on the 4-hour chart / daily chart. And you can see how nice this trend has been acting, also breaking the top of 103.73. Okay, so first of all, first conclusion here, uptrend, right? When we were looking yesterday, no doubt about it. Even difficult to imagine that this is not an uptrend, right? Very, very clear example. So let's zoom into the 4-hour chart. We were talking about a 103.73 resistance, right? On the left, the top there, do you see that daily chart top on the left there, 103.73, it says. Keep that in mind as we move forward to the 4-hour chart. If we put a resistance line, do we not to know where the trend is? We also want to understand where the support and resistance is, because that's the natural support and resistance. That's the natural boundaries of the market where we can expect tough times maybe for the trend. Trends continue most of the time until they reach a higher time frame support and resistance. Not always will they break that support and resistance. They might. Usually, though, after some significant consolidation period, or they might actually respect that level and retrace from that. In this case, the dollar yen 2 on the 4-hour chart, unfortunately, you just don't see it, but on the left, there was a substantial sideways zone. Finally, we had the power to punch through the red line and with a sustainable push. As you can see, the first push on the very left only had a bit of a wick there. And the difference with that first break is that obviously we didn't have any candles above the first red line, right? So that was actually a mini break, but not a full sustainable break. Then we made that retrace, and the second breakthrough, the second time we pushed through the red lines, there we see price full hourly, 4-hourly candles above that level. And that tells us that this time around, the break is sustainable. This time the break is not just a mini break. It's not maybe what some could call a false break. No, it's where substantial price action is above the top. And what happens then? Then we know there's a substantial statistical percentage that, or statistic or probability, I should say, that the resistance becomes support. Former resistance that was acting as a barrier, now in fact becoming a potential support level. That's exactly what happened. That's why I made it green, to show you the different thinking here of the dollar yen. And indeed, price bounced off it to the upside. So we don't have that resistance left. We make another deeper retracement after the continuation to the bottom of the trend channel, as you can see. Okay, so we're in this trend channel as we continue along. So let's take a look at more recent price action yesterday. Okay, now don't look at the right side of the chart because that is future price action. Of course, we were looking at basically, do you see that purple circle there? That's where we were looking at price action yesterday. Okay, just to give you. So what we were looking at is a wick at that support level. So what happened was, let me go back. We had a second hook back at the green line. Do you see the confluence between the green and the blue channel there at 104 on the right side? So that's what I'm zooming into here. That was a second hook back to the same support level. And what do we see on the 4-hour chart? A big wick at that support. Now that's we see that support level there, and the fact that the market, the price bounced off it. We do, though, however, still see a downtrend. We still see lower lows and lower highs in this process, so we were cautious. So when looking at this setup, we therefore did not take the initial break. It's something we skipped because of the 4-hour down momentum yet. But what happened during our session is that although we skipped the breakout to the upside purposely because of this downside, as you can see, lower lows and lower highs, price did break through it through that level and thereby made a higher high. All right. So by this higher high, of course, within this downtrend channel, and the fact that we're at the bottom of this downtrend channel indicated that there could be a follow-through of that upside. All right. So that was the thinking at that time when we were looking at these multiple time frame analysis and these charts. Okay. So if we then zoom into the hourly, you can see here the trend line that we put on our charts. And what we wanted to see basically on the hourly was a sustainable breakout. All right. We didn't want to take the first breakout because of the heightened fear or expectations that it could be a false breakout. We had FOMC yesterday evening, in fact. That was a factor too. In fact, when you have a big news event like that, there is a higher chance of a false breakout because the price moves into one direction and there's no follow-through from the market because the market also realizes that there could be some quietness before the storm, some quietness before the FOMC meeting minute releases, and thereby actually price, when it breaks out, then returning to its kind of its average. And in that case, the breakout wouldn't be that profitable for us. So that was our expectation, something we were planning on. So that's why we wanted to do that. And how do we do that? How do we wait? How do we recognize that that breakout here would be sustainable? And we were looking, to be precise, at price action. What we wanted, and I don't know if anyone from the trading room is in here, maybe not, who can confirm that, we wanted a full 1 hour candle above it. Right? That was one of the things. Price action, the hourly candle above it. We also wanted the hourly candle that wasn't with a big wick. We wanted the hourly candle that had a close near the high. That was the second thing. So we have this beautiful purple trend line acting as resistance and price pushing through it on the right side. But that wasn't enough. We wanted the confirmation. And we waited, the hourly closed, and that's what we got. So that is what we looked for. A good push through, and then the second candle pushing even a bit higher, and then we got to retrace. So then it was time for us to plan the trade. We got the trigger that we wanted, and right, we planned the trade. Then it's time to trade the plan. So basically, I'm not sure if that question is for me, Sam J, but this was a live trade taken by our trading room members, or many took them. I asked them the day after, and so we're just showing you the process of how we look using these three elements in distinguishing trades. Alrighty, so we had that. We planned the trade, and how did we plan that trade? I'll show you that right now. We put a fib from the bottom of what we consider the swing low up to the swing high, and we planned the entry at the 50 fib. To be honest, I did say that I think there would be a bit deeper fib, but we still planned it at the 50 because we wanted to be, sometimes if you plan bounces off a shallow fib, then the trade misses you. So we judged the 50 to be a decent entry level, also because the 50 was equal to the trend line that we broke. So sometimes that trend line, the broken trend line, also becomes a support in the future. Therefore, that's why we chose the 50. The price actually went to the 780.6, but that wasn't a problem because we put the stop loss below the 100%, below the swing low bottom, in fact. So that's where we put that the stop loss. That was fine. And you can see we targeted, as I already said at the beginning, our aim always is the minus 272 and the minus 618 targets here, where we are looking to go for. So small pause at the minus 272, and then the minus 618. We got a push just a bit later, and that's actually where price stopped. It's been a big consolidation after that. The dollar yen didn't really go anywhere after this this push up, and it was about 50 pips, and the risk was 27. So it was about, what is it, 1.8 or so, 1.85 reward to risk on this trade. So that was the the thinking behind it, as you can see, putting all these facets together to come up with a judgment about our trade. Now, of course, we have rules that we look for. We have strategy guidelines and rules, very concrete. We even have a Word document lined up with all that information. But these are elements that we want to use on every single occasion to judge whether that particular strategy is at a time that we want to implement it. I'm not sure if you can see my mouse. If so, I could definitely use it. I wasn't aware that you can see my mouse. So thanks, Kevin, for that. If we take any specific time into account, well, not sure if what you mean with that, Ann. We take the multiple time frame analysis. I don't think you mean that. You mean how long the time takes to develop for the trade, maybe? We do a bit, definitely. If a breakout trade doesn't materialize within 6 hours, that's normally the time when we say, okay, this is taking too long. Oh, late in the day. Well, we do, but in this case, with pullback trades, it's a bit different. Pullback trades, we give up to 2 days the time to materialize, whereas breakout trades, we give 6 hours. That's because there's a bit of a different psychology. We tend to take the breakout trades on lower time frames, which means we want to see the follow through more immediately. The breakout trades are in fact more geared towards catching price action within the day, roughly speaking, whereas this pullback trade is in fact trying to catch, let's say, swings or mini swings within the week. So that's why we give a bit more time, and therefore that element wouldn't count or wouldn't be relevant for this particular trade. Yes, we would put limits indeed on the trade. It would be specific stop loss, specific entry or entries, and TP/TPs, take profits, and those would be indeed very clear. Indeed. So, that's always the best because it reduces, in my opinion, it reduces the psychological barriers in fighting your trade. I mean, everything is clear. You just have to stick to the plan. Of course, that's not as easy as it sounds, but at least the plan is clear. So that's what we like about it. In some occasions, if we deem the space nice, we would even use trail stops with the breakout, for example, because it doesn't hurt sometimes to trail a trade. Sometimes price goes a bit further than you might plan for, so that sometimes helps. Tony T, well, this is a universal strategy. So although my expertise in this field is limited, I'm fully focused on Forex. I can imagine, that these universal trading concepts would apply there too. But that's just, of course, my my guesstimate. But basically, what we're trading here is nothing really fancy in the sense that this is core technical analysis trading. We don't use like a series of 10 mixes where we have 10 different indicators that we want to mix to come up with this kind of unique cocktail of indicators overlapping and confirming each other, for example. To give you a bit of an extreme example maybe, but I'm sure there's some that do that. The trail stop, when using the breakout, primarily most of the time, we'll use these fractals. You see these triangles here? I'm not sure if you know, Jason, the fractal itself, but we use a fractal. So we use that as an indication of support and resistance because that's when we have 2 candles to the left and 2 candles to the right, where the price is at the lowest or highest. And you can see, even in this example on the 50-minute chart, how this particular breakout, if you would trail stop it here by a couple of pips, you wouldn't get a bad exit price. You would exit just around 104.90, which isn't too far off from the -6 target, -618 target that we had planned anyhow. So as a trail stop, I think the fractals do their job decently. Of course, you can use others, but this is what we use, the fractals. Yes, indeed. And when trailing, we use indeed the pullback. Basically, when we get a pullback, there would be a fractal indeed. So the fractal equals kind of the mini pullback. Yes, I am saying fractal indeed. And frankly, you did spell it correctly. It is a simple indicator that just indicates, it's a indicator that shows all the support and resistances, because each fractal has its high or low candle has two candles to the left and two candles to the right where price isn't higher or lower. So if the fractal is above price, okay, fractal is above price. Let's take this one example where I have my pointer now. If the fractal is above it, that means that particular candle high is the highest high of two candles to the left and two candles to the right at minimum. But of course, as you can see, in this case, there are actually a lot of candles lower and a lot of candles to the left and a lot of candles lower to the right. So that is the minimum, but certainly not the maximum. There could be a lot of candles. And of course, if there are a lot of candles, then this is actually a kind of mini important top on this time frame, right? But all these fractals have that minimum 2 to 2 on the left, 2 on the right. It's a very simple tool, but it makes it visually a lot easier to decipher support and resistance. And that's basically very crucial for us. We use a lot of support resistance on the daily, the weekly, the 4-hour to investigate, identify where that wide open space is for us to take those breakout and swing trades upon the pullback. So that's the fractals really using for support and resistance. Then, of course, we can calculate the reward to risk and look for confirmation on price action. You can find this. I'm not sure. It should be on every trading software that I know of, but I've never seen it not available. It's part of Bill Williams. It's been created by Bill Williams, a famous trader, and you can find that particular indicator normally under his folder of indicators. Let me say it this way. If you have MT4, for example, you can find it by going to Insert Indicators, Bill Williams, Fractals. All right. So you can download our report right here, in fact. That does explain this breakout and pullback strategy that we employ. So if you found that interesting, by all means, take a look. I think it's an interesting mix of a bit of a swing plus a bit of an intraday trade, thereby capitalizing on two different types of potential spaces or movements. Sorry to hear that, Jason. That's a pity because I found it visually very handy indeed. Maybe you can send them an email to support, ask if they can add it, because I think it's, from a program technical point of view, I can't imagine it could be complicated, but it's one of the simplest indicators probably out there. Ben, I know him as Bill Williams, but maybe that's his nickname, maybe. So that's possible. I wasn't aware of that though. We're able to access it. Let me open it myself. Let's see. Yeah, I'm able to open it. So maybe just try it again, Gene, if you'd like. It is working from my end. So, and the only thing you have to, of course, add is your email, in fact, and you can click on download the strategy, and that will be sent to you. Yeah, we can put that link there, no problem. Let me. Oh, thanks, Morgan. There it is. Good. Oh. Goody good. Yes, indeed, Toby. He has other indicators. We don't use those. We use the awesome oscillator. Sorry. But not the others. So if there are any questions, by all means, Nathan and I are here to put your help. Maybe you want to see those examples again. We basically gave 3 examples: one on the euro dollar, two on the euro dollar, in fact, and one on the dollar yen. Yeah, awesome oscillator is a good one indeed. Really very useful. We use it in multiple ways. We use it for divergence, convergence readings. We use it for swing highs, swing lows, minimum retracements, expectations, for even trend identification sometimes. So it's very useful. Other than that, we have 2 moving averages, just to, not really for our strategy, but just to give an idea sometimes of what the trend could be. And then we stick to our core trading concepts such as trend lines, fibs, and put that all together with support and resistance. And this is what you get. Sean, I guess it'll just take a few minutes, or I hope. If not, by all means, please write an email to us or TradingPub, and we'll send you. We'll try to get you that report. But I guess it'll just take a few minutes, I guess, before that email comes, or I hope at least. Stochastics, no. We primarily use the awesome oscillator. Sometimes we would add, if there are cases, specific cases where we'd like to get more information, we would add the ADX or a CCI sometimes. But we don't have it standard on the chart, let me say it this way. But in specific situations, yes. So for us, what other criteria we can use? Basically, for us, we define this process as follows. We have step 1 is really the trend identification here, what we have going for us. Then we look at the opportunity. We want to pull back within the trend, for example. So we take it a very step-by-step process. If we see a opportunity, then we check filters. Is there anything blocking the trade from materializing, right? Is there anything that could hinder trade, like divergence or support and resistance? So that's the first 3 steps we take. We do that on all the currency pairs, in fact, to give you an idea. That will basically give us the watch list, right? Once we have a watch list, then we actually take a look at step 4 of those particular currency pairs and see if anyone is close to being triggered. So the first 3 is the analysis: the trend, the filters, and the opportunities. Then we make a watch list, and then we look if there are any particular triggers that are worth trading upon. So that could be a trend line, it could be a hook back. Once we have a trigger in place and the trigger gets, well, the price hits the trigger, let me say it this way, then we establish our trading plan and the entries and exits and the specific trade management, and that of course are guided by our rules as well. But we do have some rules that allow for variations, and that is what we discuss. And we set up the last factor. So it's like a 5-step process, as you can see. And I think it's very straightforward, and I like this process, and I like the way we tackle the market through this lens. Oh, I thought we had one more slide, but I think that was actually deleted. I wanted to show you the advantages of our DTT strategy, but basically what it boils down to, I think, is to summarize it. With the DTT, you have a great scale in and scale out. Why? Because we're constantly taking a trade on the break, exiting, then scaling in upon the pullback, and then exiting. So this automatic scale in and scale out means that we're reducing, we're adding on risk when we're winning. So it also allows for bigger wins, smaller losses. Very critical, of course. Let's see, Franklin B. Sorry about that. Not sure what's the problem there then with the email. I hope it's just a question of waiting. So basically, when you left, then the download worked. So maybe that would be the solution. Not sure if the SMI indicator can be downloaded to TC2000. I would have to check. So the exited entries, basically, we either use the fib, right? Or in the case of breakout, we would use trend lines and fractals as an entry. And exits, we use the support and resistance, of course, depending on the direction. If we're in an uptrend, we're aiming for the higher resistance. If we're in a downtrend, we're looking for the next support. All right, so that is, we're looking for these natural targets where we have that wide open space up to the next level, right? The currency has all these levels, and sometimes there is more space between these levels, so we're trying to identify where is that space. We try to trade it from one level to another. Because whatever the reason is for price to move at its space and direction, it basically boils down to that. Price bouncing from one level to another, from one support and resistance to another. And we're trying to identify that through these stepped process. And yes, in all those cases, indeed, we use pending orders. Well, I mean, 95%, I would say. In some cases, a level has been broken already. And then we realize that we could have entered, or we want to enter at the level, and then we would take a market order. But in most cases, it is a pending order, as if we thoroughly plan the trade setup. So I'm going to pass it on to Nathan, who's going to round up the last bit of the session. I guess we might be ending soon because we did start a bit later, but it was a bit my fault. Once again, apologies for that, and thank you for patience and sticking around, in fact. So I hope you enjoy that, and I'll pass it over to Nathan. Cheers, everyone.
Hi, guys, and thanks, Chris, for that. You know, Chris tried to cover a lot of ground today in terms of talking about discretionary trading. That's, of course, a pretty massive topic that you could have entire training programs on, just the idea of that. And so, you know, what we're trying to get across more than anything is not, you know, is not just the idea of using these techniques. You know, that multiple time frame analysis or Fibonacci or whatever these things are, that you have to use them. Really, the overarching thing that we're trying to describe here is that when it comes to manual trading, the way to get success is to build your evidence. In other words, it's not just to, you know, follow some basic strategy blindly. And you know, I use the moving average crossover as a common example, because that's a, you know, a common strategy you'll see. Basic, you know, when the X moving average crosses the X moving average, you enter a trade. And the reason that doesn't work is that the market is too smart for that. The market knows, you know, that there's people trying to follow that way, and especially in the currency market where it's a zero-sum market, there's the impossibility that exists for everyone to profit. And so the market quickly fixes that problem by doing a lot of things that cause people to lose a lot of money. And so what you have to do as a manual trader, and of course, again, I'm talking about the currency market, but in any market, is that you have to build the evidence for every trade. You can start out with a basic strategy, you know, something like a trend line break or even a moving average crossover. But what you have to do from that point is to go on and build your evidence so that you can qualify your trades and increase your accuracy by whatever percentage needs increase. So, for example, if you're averaging a 1-to-1 risk-reward strategy, obviously you need to get your accuracy percentage up to above 50%. That's what's required of you to be a profitable trader. Most people who are trading at a 1-to-1 risk-to-reward ratio are winning like 30% of their trades. Of course, a very negative accuracy number, causing them to lose money. And the reason that that's happening is because the market, and the way that it moves specifically in currency trading, is that it's looking at these orders and it's filling things and moving in a way that directly requires it to take money out of other traders' accounts in order to fuel its movement. And so if you're not building your evidence in terms of qualifying those trades, then you're going to be at the losing end consistently. So Chris went over a few ways that you can build your evidence, talking about multiple time frame analysis, which a lot of people don't do. A lot of people will say, I'm an hourly trader. Well, what is an hourly trader? That means you look at one time frame and you watch for this candlestick to do this and that candlestick to do that, and then you take a trade. Well, how do you expect someone who's looking at a 1 hour chart and making these decisions to compete with a professional trader who's weighing the evidence, who's looking at multiple time frames, has their Fibonacci levels drawn from weekly and daily levels, knows where the trends are, knows what levels are critical, and they're taking in all this evidence, and you have someone who's looking at a 1 hour moving cross and trying to trade that way. It's completely, one-sided battle, for instance, if you want to put it in terms of that, of one trader versus another. And so that's what we try to avoid, is being on the losing end from the, in the installment process, basically. We try to give you the ability to build the evidence in your favor. And so I actually wanted to go ahead and share my screen here for just a second to drive this point home. Let's see if I can get this projector to load. Sometimes it only works on Internet Explorer. So let me, I'll try to give you a more tangible example of that if I can. But if you download our double trend trap strategy, you'll see that the entire strategy is actually built on that basis that you have to have some things in terms of confirmation that are on your side. So in other words, if you have a trend and you're saying, okay, I'm going to buy on any pullbacks of a trend, well, that might make sense in theory. That might be a fundamentally sound way to look at the market, but that's not going to give you an advantage over all the other people who are trying to trade the same market. I'm going to go ahead and log in here to Internet Explorer, see if I can share the screen with you real quick. Okay, so basically, let me give you an example. If you guys can all see the whiteboard, and you'll see what I'm doing here. If you have a trend, let's say that the trend is going up, right? You have this uptrend. Well, the problem is, and I've seen people teach like this, in hindsight, it looks like, of course, it'd be very easy to trade this trend, right? You have all these pullbacks, and you say, okay, when the market pulls back, what we're going to do is we're going to buy on the low, we're going to trade this market up. And that sounds great in theory. The problem is, if you zoom into one of these moves that's going in a counter trend direction, what you'll see in a very zoomed up way is that the market has even a smaller trend that is going the opposite direction. And so as a trader, then all of a sudden, it's not just, okay, buy on the pullback. Now you have to determine whether this is the pullback that you're supposed to buy on, or this is the pullback that you're supposed to buy on, or this is the pullback that you're supposed to buy on. Where actually are you supposed to buy? Because if you buy as soon as the market starts pulling back and maybe put a stop loss below a low, obviously you're going to get crushed on that trade because the market, you have no idea of knowing where the market is going to stop. Does that make sense to everyone? This is really what's going on when you zoom in and you're actually talking about making a trade in a pullback of a trend. So you have to go a step further than just saying, I'm going to buy on pullbacks. You have to rationalize where there's confirmation to actually believe this market's going to continue. There's no way of just, as soon as the market starts moving down, picking your entry to buy and getting it right a high enough percentage of the time in order to be a profitable trader. So what our double trend trap method does is it says, okay, here's the trend, and I'll just draw it quickly for you again. Okay, it says here's the trend, so that our bias is to the upside. We want to buy. But now we have to determine when it makes sense to buy. So we zoom in to like a 15-minute chart. And as this is moving down on the 15-minute chart, what we're seeing is a small downtrend develop. Okay, and it might not always be this pretty, but it'll be something like that. And so then what we'll do is we'll draw a trend line on that smaller time frame that's going in the opposite direction of the trend. And when that breaks out to the upside, then we have some confirmation that this trend on our longer time frame is actually going to continue, that it's not just a random pullback. And so what we do is we wait for this, we're patient, we wait for this to show that there's confirmation that this uptrend is continuing, and we buy into that area. Then we have a reasonable place to put our stop loss, which is right here. We have a reasonable place to put our target, which is sometimes at the top here, because we know that price has just been there and is likely to go there again. Or we use some kind of Fibonacci extension to increase our reward and go for a higher target, which of course decreases the percentage of the wins that you're going to get, but it increases your risk to reward. And so there's a ratio there that you have to keep intact. Now some people want to win 70% of their trades and trade with a negative risk to reward. Some people want to trade with a 20% winning ratio or winning percentage and trade with a much better risk to reward. And there's different ways of achieving both. What we try to do at Winners Edge Trading is be around the 40% win mark and try to average as close to a 1-to-2 risk to reward ratio as possible. And that way, with the 40% winning percentage, we're very net profitable over a series of trades. So just to give you that math real quick so you know where I'm coming from on that, I'll say if you take 10 trades, just to make the math really simple, I can't draw. If you have 10 trades and you're going to go ahead and win 4 out of those, okay, those are wins, and you're going to lose 6, and you're risking 1% on each, well then you're going to have 8% in wins, and you're going to have 6% in losses, which is a net 2% gain. So that's what the math looks like over a series of trades with a 40% winning ratio and a 1-to-2 risk to reward. And that's why we go with that method, because a 40% winning ratio is pretty doable when you're using these types of strategies where you're using the trend to your advantage, you're using fib levels and things like that to your advantage, and you're just tilting the scale a little bit. I talked about building the evidence. You're just tilting the scale a little bit. You know, a lot of traders or trading educators will talk about a pin bar entry. Well, what is a pin bar without some kind of supporting evidence as to why you're going to go in on a specific pin bar compared to all the other losing pin bars? Where's your target going to be? Where's your stop loss going to be? There's a lot of other components that you're going to have to deal with if you want to be profitable beyond just what an entry or what a setup looks like. And so that's what we try to do. We try to build that evidence so that we're winning enough trades to have a net profitable experience over a set of those trades. Okay, so in short, that's what a winning system is all about. Beyond just a trade setup, that's what a winning strategy actually looks like, and that's what we build. I think it's about 12:40, so I'm going to go ahead and wrap up. I want to again thank Morgan and TradingPub so much for having us. We really enjoy being able to come out and see hundreds of people who are interested in trading education. It's a great opportunity for us to to get to know more traders and to talk about what we're doing, and we really appreciate that TradingPub consistently has these awesome events. So thank you again, Morgan, and thanks everyone for bearing with us for the last hour or so. And grab that strategy if you want, and we'll I'm sure see you again in a presentation in the future.